Hello, everyone, and welcome back to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'm going to be facilitating this session tonight with Mr. Rob Roy and special guest Mr. Jeffrey Beamer. First and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We have this available on our website, so please feel free to read this in detail there at any time, or take a screenshot of it now if you like, but that's the main point to take away from it. Most of us are likely familiar with the Q&A process, but for anyone that might be joining us for the first time or relatively new, welcome. It's great to have you on board. We do have a process for Q&A. Keep in mind the Q&A portion is brief for the session. Rob will go through his general presentation, open it up to, or look for some case study considerations, and then open it up to questions from the multiple live streaming platforms with the time remaining. So that covers off all the housekeeping details per usual. The CPI report today came in basically as expected. However, there was a headline on CNBC that their survey showed the Fed will start cutting rates this coming summer. I wonder how Rob feels about that, and very excited to interact with you all. So thank you for joining us for this live session. And at this moment in time, here's Mr. Rob Roy.
Thanks, Zach, and welcome everyone to TradeFinder Live. I saw that headline as well. I'm wondering who their survey was. It was a CNBC Fed survey. Well, who in the Fed did they talk to? Because none of the Fed governors that I've heard are talking about rate cuts anytime soon. But that was the headline. I don't know if that's the market trying to figure things out. Whatever. But yeah, the CPI report was pretty much in line with expectations. And so you would have thought that would have been a pretty good signal. And, the market ended up having a pretty decent day today. Taking a look at a chart of the S&P, you can see that, 3 straight days, boom, 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 breaking above that 460 level. We talked about this numerous times that we had to get above 460 with follow through, and we've done that. So at this point in time, I think you have to be pretty bullish on the markets. So there you can see the video popped on back in the mountains. Drove all night, so a little tired at the moment, but that's the way it goes. But the fact that not only did we break above 460 with follow through, notice now we do have a 5-wave impulse pattern. So it's labeled as a wave 3 now. And we've been talking about this for quite some time, that we didn't have a 5-wave pattern labeled. We do now. And it makes sense, doesn't it? We've been talking about we needed to break above that resistance at 460. We needed to do it with follow through, and we did it. And so the Elliott Wave algorithm says, yep, that's good to go, and labeled that with a wave 3. So now it looks like at some point in time, the S&P wants to hit this 480 level. Now, as a quick reminder, we talk about how when you're in a wave 3, these wave 4 and 5 numbers here are projections. It doesn't mean the wave 4 is starting now. It means if the wave 4 was to start now, that's the point where you could expect to find a little bit of support down there around 440. And then from then, perhaps you go on to the wave 5. But whatever the reason is, the algorithm, the Elliott Wave algorithm, as programmed by this software, which is Profit Source. You can find out more about it at hubb.com, hub.com, and the beta version is out on the live version, so we're still excited about that. So not just in today, you're going to get Elliott Wave charts live here very soon. So that beta version out. So if you have interest in it, contact the folks at support@hub.com. But the algorithm likes this 480 level. So when you're in a wave 3, you
Brief interruption there.
On the wave 5. So those of you that may not be as familiar with trading wave 3s, which is one of the things I really like to do, is trade the wave 3. That's a target price either way, whether in the wave 3 or a wave 4 correction, and then moving into new wave 5. So pretty exciting stuff that we actually have this relabeling of the Elliott Wave pattern, or new labeling of the Elliott Wave pattern, and breaking above 460. As Zach mentioned, we do have Mr. Jeffrey Beamer with us tonight. Welcome, Jeff. Glad to have you.
Hey Rob, I'm here. I'm here. I was just pulling up, you're talking about the S&P, and I was just pulling up my prediction that I posted on the Hub platform 4 months ago. I said year-end target. I was looking it up. I put 485 on the spider for year-end target. And I did that 4 months ago off of an Elliott Wave count that was on spider. So it did reappear, the Elliott Wave count.
Wow, that's pretty interesting, and it looks like you're going to be spot on with that 485 because this tap box here has a low range and a high range, and it just labels it in the midpoint. So
Yeah.
anywhere between 475 up there to 485 is the expected range. So it just puts that 5 in the middle. So your 485 could very easily be hit. So I'm sure that would be exciting. And that the way 3 has broken that resistance, it looks pretty darn impressive. And then you look at the DMI.
I mean, I didn't look like a genius back in October, but I look like a genius now, don't I?
Well, what have you done for me lately, right? Who cares what happened back then? Yeah, so it all matters what's going on now. So I was going to ask you if you had any thoughts on the market, but sounds like you're pretty much in line with what's going on, since the market is trying to make you look like a genius with hitting your target spot on. I bet there's an awful lot of investment managers out there that would like to have been trading according to your forecasted price. So any other comments on what's going on with the market?
Oh no, I just took that one just because I was, looking good so far. I mean, I other
no.
Yeah, so anyway, yeah. Keep going. I'm sorry to interrupt.
Oh no, not at all. In fact, we're happy to have you. And if the folks are wondering why you're here on this specific episode, it's because we have a special presentation, you and I, tomorrow night about a new strategy that is a combination of our skills, you and I working together. So we have had where I've had portfolios, you've had portfolios. And we've issued trade alerts based on our own, but we haven't had one where we've been working in concert with each other. This is the first time that's happened, and we're going to be letting the folks know about it tomorrow night. So if you have any comments along those lines, and Zach, hopefully you'll put the link in the chat box for people that want to register. It's free, doesn't cost you a thing. You can show up and hear us talk about what we're going to be doing.
Yeah, 8 p.m. Eastern time, 7 p.m. Central is when Rob and I are going to be starting that session. And, it's going to be talking about a bunch of stuff that we've been doing, and then combining forces together. We realized, wow, it's impressive when the body of work is combined together. And that's what we're going to talk about tomorrow night. So,
yeah, one of the things that we've noticed hasn't it been that even though we're focusing on delta neutral, and that's what we're going to be focusing on in the presentation and the strategy, that we have slightly different ways of getting to delta neutral, but they've complemented each other, right? And we've had several trades, which is bizarre, where at times we've each had a trade on the same stock with different strategies, both delta neutral, and then we've also had times where you've had a particular strategy on, and then I came with a delta neutral strategy after that. So back to back. So we've had both of those. It's been pretty interesting. So we're pretty excited about this. So
and speaking of delta neutral, I thought I'd just, since I'm on TradeFinder, I had to, I don't mean to interrupt your market overview, but how about if I throw out a trade here right at the beginning of the show?
Absolutely. Yeah, no, we love doing trades here on TradeFinder. So if you've got one, fire it away.
Well,
last time you did this, it was a home run. So pressure's on. Pressure's on.
I need you to drive for a second, but let me just say,
okay.
That tomorrow night we're going to be talking about actually some of the criteria that we use, and I'll give you one of them right now, and it's earnings related. Okay, and so I do a lot, and Rob does a lot around earnings, and trading earnings announcements can be a little tricky. It's one of the things that we're going to be talking about tomorrow night. But the trade that I got for you tonight is going to be on KMX. It's CarMax. And this is kind of a sister publication to what we're going to be talking about tomorrow night, because this is going to be what we call a potential for breakout. Okay, so next week CarMax has earnings. It's on Thursday morning. Okay, so a week from this Thursday. And this is a stock, if you see that last earnings announcement back there in September, that little drop right there generated a 52% return on our trade in one day. Okay, we put that trade on the day before earnings, and sat through the announcement and got the announcement, and down that stock went. And we ended up taking the trade off, but as Rob was drawing that second arrow there, had you stayed in it and managed the trade a little bit, it probably would have doubled in value. We took it off with about a 52% gain in one day. We took it off on that drop. And so what I expect to happen is this to occur again. Now, what you're going to want to do is use a strategy that can benefit from a big move in a stock either way. That means a strangle or a straddle. And I would suggest, maybe looking at it next week. You could put it on this week and maybe ride some implied volatility rush, and maybe make a little bit of money before the earnings announcement. But this is a stock that we typically, if you look back in June at the previous earnings announcement, you can see that little pop right there. Well, guess what that did to us? I mean, another big winner in one day. So CarMax has so far been very kind to us with our breakout strategy. And so this is the trade that I'll give you guys. If you have anything on that is, maybe sideways oriented, because as you can see, the stock has been forming a wedge, here, I would anticipate a breakout either direction. I don't know if it's going to go up or down, but I don't think it's going to go sideways. So we'll see.
Sure doesn't look like it. And for those of you that may not be familiar and weren't around when Jeff gave his last example here on TradeFinder, he was doing something similar on a breakout, which did break out and made a nice gain. And his criteria is slightly different. I like to look for these triangles, so that's why I drew the triangle on here. So this one's kind of, in my mind, the best of both worlds. So
yeah,
the criteria that Jeff looks at from an implied volatility standpoint on stocks that are getting ready to break out, it qualified, and then also, which is kind of like just a cherry on top, right? Has a nice little triangle pattern as well. So I think this is a great one. So thanks for sharing that with the folks, and hopefully people will follow that. And
I see a quick question, easy question there. Earnings is Thursday, December 21st. Nice little. Hopefully this is a nice little Christmas gift for you.
Yeah, that would be nice, wouldn't it? Right before the Christmas break. So yeah, I like that one a lot. Thanks, Jeff. Thanks for popping in and sharing that with the folks. And we always look for trade considerations here at TradeFinder. So last time we went with yours and it worked great. So I expect nothing less this time either. So thanks again for showing up. Appreciate it.
You bet. You guys have hope to see everybody tomorrow night. Everybody have a great night, and I'll let Rob back to his regularly scheduled program.
Yeah, sounds great. I look forward to tomorrow night as well, Jeff. So yeah, right. Thanks for popping in. Appreciate it very much.
All right, see ya.
All right. So let's go ahead and switch over to interest rates. And Zach was using my phrase of the song remains the same, because there was a time when rates went up, the market went down. When rates went down, the market went up. And it's kind of deviated from that a little bit, but not today. So rates went down a little bit today, and then we had that big move to the upside. However, rates are still hanging around this 50% correction level on the way forward. I think that bears watching. If we break below that, we still have the 61.8% level that could hold on rates. We could go lower and disqualify this pattern, or we could hold here and turn. And if we do start to move back to the upside in rates on the 10-year, I think that would be difficult for specifically the tech stocks, but the market in general. But so far, it's just trying to hang around this corrective level, but it still bears watching. It's not an all clear signal, even with the S&P breaking above 460, which is very important with the follow through, and the fact that the algorithm is labeled at a wave 3. Those are very positive if you're looking to go long the market, but you don't want to see this. If you want to go long the market, or you are long the market, you don't want to see rates turn and kick back to the upside. You just soon see them hang around down here, or even break below this wave 4 and disqualify this pattern. That would be the ideal scenario. And if that survey is right, which again, Fed survey, who were they talking to? I just can't imagine that there's any voting members of the FOMC that are saying, yeah, we think we're going to probably start cutting rates next summer. I just don't believe anybody would say that. So I'm not sure where that came from. And so that they, as Zach mentioned, a pretty interesting headline, and certainly worth some chatter. But I don't know, who they're talking to. It's certainly not Chairman Powell, because he isn't talking like that at all. And then we look at the dollar, and we have the dollar here that tried to come off those lows, also in a wave 4, but that one's at the 61.8% fib level. So if it breaks that, then it does disqualify the pattern, but you don't really want that. If the dollar breaks down, that would mean way more of a recession than when they're talking about. In fact, in that headline that Zach referenced, the article, I happen to see the same one in Reddit, is that they're expecting this soft landing scenario. They feel pretty confident that the Fed's done it. They've engineered it. They've created this soft landing. I think it's too early to say that, and I think it's way too early to start talking about the Fed cutting rates next summer. Now, I have said, because the market is pricing in 100 basis points of rate cuts next summer, next year, excuse me, 100 basis points. Let me be clear on that. 100 basis points of rate cuts next year. I had come out and said I didn't think we'd see anything before the summer at the earliest. So it is interesting that they did say start cutting rates by the summer. But are we going to get 100 basis points by the end of the year if we don't start till the summer? I don't know. Anyway, it was an interesting headline. I'm glad Zach brought it up. But taking a look at the dollar here, if the dollar rolls over, which it looks like it's trying to do, that's global weakness, and that looks like a global recession. And why wouldn't money be moving into the dollar? I guess an argument could be, well, if the Fed starts cutting rates again, we start getting easy money policy again, and the U.S. starts going further into debt, then that could damage the dollar. That's the argument for it going lower. But there's also a more nefarious argument of perhaps this whole recessionary thing gets far more severe than what people are pricing into the market. So, pick your favorite analogy on why the dollar is acting like this. Now, on the positive side, it really just kind of went up and bumped its head at 104, which is resistance from back in June, as you can see. So that may be all it is on its march back to the upside. If the U.S. is going to come out of this without a significant recession, if we're going to have this soft landing that people are talking about so much, then you would expect the dollar to become strong as the U.S. economy doesn't fall down as much as some people, including myself, have thought. I still feel, based on the bond market, I cannot ignore the bond market, but based on what the bond market's shown us, I think there is more of a risk than what's being priced into the market right now of a recession. However, if that doesn't materialize, then the dollar most likely does go surging back to the upside. And perhaps just this bump of the head at 104 for resistance is short-lived, and we break above that and take off. So kind of interesting on where we go with the dollar from here. I did want to show you the VIX because the VIX, you can see there, made a pretty significant break. Now, the last time we tried to break 13 this significantly was back there on the 8th of December, and we kind of moved a little bit higher the next day, not a whole lot, but we didn't have a follow-through day. And on today's break of the 13 level, it's a stronger move, closing at 1207. So not only did we break 13, we closed all the way down around 12. And if you're watching an intraday chart of the VIX, which I was, and you could see it. And so, yeah, we've talked about this before. There's the wave 5. Just because 12 has acted as support going all the way back to June, and every time we've gotten here, we've had some volatility come into the market, doesn't mean it has to happen every time. Nothing works every time. Nothing works 100% of the time. And we have had the VIX down at 10 or lower in the past few years. So it's not that much of a stretch to think that the VIX breaking below this supported 13 couldn't go lower. It can go lower. In fact, pretty interesting here that 5 projection there is down at 9. So that would be getting near, significant lows from the past couple of decades, really. But it's been there before, so it could happen. Bitcoin, and we've talked about this big March higher, and I've made mention that I've been, you've had to stay long Bitcoin as long as it got above it, stayed above that 25,000 level, and it took off. And it's been pretty impressive on the moves, but you just got to keep this vertical stuff in the back of your mind. And this is exactly why. So even though we broke vertically and had about as solid of a consolidation as you could ask for, just a beautiful creeping 45-degree angle, we never did retrace any of that part of the vertical move. And then out of that nice 45-degree angle move, we went vertically again. Well, now we've given that back. And so if you're long Bitcoin or the cryptos, you should be happy about that, because you can't get too many of these vertical moves without getting some sort of a significant correction. And so far, it's been okay. The correction is held above 40,000. And at the time of this recording, because I know trades 24/7, but this is the end of day version of the profit source software. Again, I mentioned earlier that the live version is in beta testing, and I can't tell you how excited we all are about that. But it's still held above 40,000, and that becomes really important now that we can try to hold this level above 40,000. We look at the 10-day moving average, and yesterday and today pretty much closing right on that 10-day moving average. So I wouldn't be concerned with the pullback that happened yesterday because of that vertical move higher. You want to see this march up towards that potential wave 5 target around 50,000, more along the lines of what happened in October and November. You don't want this vertical stuff, and this is why. Now, so far it's held from the October move, but more often than not, what goes vertically up comes vertically back down. And I'm still not super comfortable about this move back down here. But so far it's held that, even though it didn't hold the last move that broke from 40,000 higher. And we're right back there. So pretty interesting there. Zach, I'm just going to go ahead and beat you to it, because I know somebody in the Q&A is going to ask about Coinbase. And as we've been talking about it, we kind of just have married these two together. Every time we talk about Bitcoin, we're just talking about Coinbase. And nice little, look at this little triangle forming here on Coinbase with a doji today. So something's getting ready to happen. We already had one heck of a move there from the beginning of November, breaking above 100 and breaking above those recent July highs. Going a little vertical for my liking, but now we have some consolidation into a symmetrical triangle with a doji today. I don't know that that means it breaks tomorrow, but perhaps it does. But there's some indecision there after this big run to the upside. I do still think that Coinbase is going to take its cues from Bitcoin, so keep an eye on Bitcoin and see what happens there. And if it continues to move higher, it likely drags us along with it. But if we did get some sort of a further correction out of Bitcoin, broke below that 40,000 level, for instance, then you could see a downside breakout out of Coinbase, which is okay. I mean, everything above this 110 level is fine, which happens to coincide exactly where that wave 4 projection is if the wave 4 was to start now. So if the wave 4 was to start now, that's what you would be looking for as far as a correction, and then a potential move back higher in the new wave 5 target. So anyway, Zach, I hope I didn't steal your thunder, but I thought I would just go ahead and share that with the folks now. And then looking at a few of our other markets real quick, you can see the Dow, which is kind of reassumed leadership, even though the S&P is quickly catching up on its move. You can see that we had this wave 5 target here at the 355 level. We broke above that in a big way back there in the end of November and beginning of December, consolidated that, and now we've broken higher again. And it looks like the DIA wants to hit 380 at some point, but once again, it's in a wave 3. Now, we've talked about this numerous times, how we didn't have a 5-wave pattern on the S&P. We didn't have a 5-wave pattern on the Dow. The only major market, we didn't have one on the Qs either. The only major market that had a 5-wave pattern was the IWM. So now we have a labeling of the S&P in a wave 3, and now we have a labeling on the DIA for the Dow in a wave 3. So what about the Qs? Let's take a look at them and see if they're joining the party yet, because we've talked about this. It's always good when the markets are in concert. They aren't always. Sometimes they are fighting each other, and usually they do come back together and join each other. And even though we've had a nice break to the upside here on the Qs, it does not have a 5-wave labeling. Perhaps that changes tomorrow, but it's not there yet. And so it sure looks like a wave 3, doesn't it? But it's got to follow all those mathematical formulas that are included in that algorithm that Mr. Elliott wrote over 100 years ago. So hasn't dotted all the I's and crossed the T's yet in the algorithm to label, but certainly looks like it's on its way. And then the IWM that did have a 5-wave pattern still does to the downside, but look where that wave 4 is, 76%. So we're right at the last bastion of a 5-wave Elliott wave pattern level, which is, call it the 78.6% Fibonacci level. We're pretty much there. So that means that if the IWM was to break any much higher from here at all, that Elliott wave pattern goes away. It becomes disqualified, and you start looking as a new impulse move here. So we'll see. You would think, based on that move on the IWM, that's probably the likely scenario, especially when you have both the S&P and the Dow labeled in wave 3s. Pretty impressive move in the IWM on the small caps. So a lot of people view those as a good indicator of risk. And so people have been willing to take risk as small caps, and so it's moved higher. So that move there is what you would expect to likely disqualify that pattern. So that's the U.S. markets. Look at a few of the international markets real quick. The EWA for Australia, breaking above 22, and it's got to really break above 23 to get too excited about it. So we're kind of in no man's land here. It held 21, which was holy cow. If it hadn't held that, you're down at 19. So it did hold it, and then we marched back up. That wave 4 is that 5-wave pattern is disqualified, as we talked about what likely could happen to the IWM. But to be anxious to go long the EWA, you want to see that break above that 23 level. We haven't looked at the German market for a bit, so let's go ahead and take a look at that. And the last time we looked at it, it was breaking to the upside, and it's continued to do that. It's like, holy cow, look at that move. Not a 5-wave pattern. It's not labeled, but it sure looks like it's headed up to test those levels there at 29.5. And then we'll see what happens once it gets there. But nice to see the the EWG performing well, when, if you remember, for a couple of years, it was just horrible. One of the worst international markets from a chart standpoint that you could find. Look what's happened to the INDA, relabeling to a wave 3. We talked about that and Thursday night's insiders meeting. So there you go, relabeling. So all that stuff that it's done on this wave 5 March doesn't look like it's completed yet. And we have that potential wave 5 target now. It's way out. It's all the way into spring of next year. So it's not like it's being forecast to happen overnight, but it does look like the INDA wants to move higher from here. We had this vertical move, I don't like that. So that I just get a little concerned and nervous about that. It's consolidated over the last week. Basically, last 5 trading days have been dead sideways. So that's good. We're allowing the 10-day moving average to catch up. But when I see these vertical moves, I can't, be just 100% well, you're never 100% confident, but the normal level of confidence that the March is going to continue higher, because you always have in the back of your mind that is that vertical move going to get retraced. But you have to trade what the charts are telling you. And so you just keep that in mind. So you keep a little cautious tone to it, but take advantage of what the chart is showing you. And at least for now, it's looking like the INDA does want to go higher, although a little more consolidation here would not be surprising, maybe even a little backing and filling here. It doesn't have to hold 47, even, break a little bit lower there, but just continue the sideways move and then get ready for the next move. I think would be really strong on the INDA. So Jeff already gave you a trade, but I wanted to show you one that we closed out today on our EWOTrader.com platform, and that's what Jeff and I are going to be talking about tomorrow night with the joint strategy that we're doing now, which is really kind of cool. Every alert that goes out to our alert subscribers at EWOTrader.com has a page just like this. So it tells you what the stock symbol is, what strategy it's in, what was the actual option trade, how many contracts, the strike, and the number of days. And so in this case, Palo Alto Networks, you can see that this is a mark-to-market graph. So we show you where every position is every single day. We're as transparent as you can possibly be at EWOTrader.com. You can see that a couple times it was down around a 34% loss, but then turned and moved back to the upside. Sometimes that happens. And when you're trading long options, time decay is going to be an enemy. So you have to be able to stomach a little bit of red there before the pattern plays out that you're expecting. And you can see here was the entry alert that was sent out with a wave 3 to the upside and that target around 320. And here we are 11 days later, taking the position off with a 46% gain. And notice what happened. All it did was consolidate sideways, and yet that still generated a 34% loss at one time. It wasn't like stock went significantly against us. That's the problem with time decay. But then after the consolidation, it broke higher. Now it hasn't hit the 320 level yet. Notice, because it's in the wave 3 and was heading towards 320, these targets move with it. So the further the wave 3 goes up, the more these wave 4 and wave 5 projections will change. So the Elliott Wave algorithm is dynamic and moves with the market. And what happened here is we had a consolidation and then we broke higher. So why did we take it off before we hit 320, which is a good question, because that was our initial target. Well, you can see there's the 10-day moving average. There's where we were at the time we took it off today. So separation there, a little bit overbought short term. We can keep an eye on it, perhaps re-enter it at another point in time. But when you have a big break like that, you get an IV rush. So implied volatility goes into the options. We'll be talking more about implied volatility tomorrow night. Again, please tomorrow night at 8 p.m. So we get this big move here. You get an IV rush. Now, if Palo Alto just goes sideways for a day or two and then starts to move higher, but it doesn't do it in these big vertical moves, you could actually see the stock higher but the call option's worth less than what we got to close out today. And so that's why we keep an eye on the volatilities in the options, in addition to what's the stock doing. So didn't quite hit the 320 level yet, but that IV rush was nice. And 46% return in just 11 days was really nice also. So looking at our past case study considerations, as you know, Jeff's already given you one for tonight. But looking at the past ones, BP, we were trying to say that, as long as we stayed above this 35 level, there's where it was when we looked at it back in October. And, it's hanging on. The analogy that I use, hanging on your fingernails on a cliff. That's what it's doing, because it's right there at those lows just below 35, and it's got to hold here. Any break below here with follow through, because see, it broke below that in May, but it had no follow through day and was able to get back above support and then eventually take off. Maybe that happens again. This is the thing that's really been kind of troubling with the whole scenario, that we're going to have a soft landing. The economy is doing better than expected. Employment is still staying fairly strong without massive wage inflation pressures. But why is energy not performing? Oil, natural gas, nothing. It just doesn't fall in line with everything else. Maybe it does. Maybe it begins to turn, and maybe energy is just significantly lagging. But until it does fall in line with what's going on in the markets, I think you still have to be a little suspect about that whole soft landing thing and everything else. And look at the headline right here. Asian stocks are mixed ahead of the Fed decision, and oil prices slump. I don't think the Fed decision is going to be any sort of a major news maker. It'd be shocking if they did anything. I don't think anybody thinks they're going to do anything. Perhaps, Powell's commentary could be interesting. Does it fall in line with this CNBC survey? I would be surprised if Chairman Powell comes out and says, we've been having discussions and we're thinking about cutting rates next summer. I'd be stunned if he said anything along those lines. But BP is gotta hold here. And another one that's been struggling is MPLX, also the same day that we looked at BP. And we came down, ran back up, tested the highs. So we got right back up to the same highs that we were looking at when we entered and pulled back. And so once again, we're at an area that needs to hold here at 35.5. So both those from October are struggling a bit, which has been unusual. The record for our case study considerations at TradeFinder has been pretty phenomenal. And all the TradeFinders are posted on YouTube. And if you wanted to, if you had a lot of time on your hands, you could go back and look at the case study considerations from the past years that we've been doing TradeFinder and find out that, they've been working out pretty well. Working out pretty well. Here's MPWR, monolithic power systems. And we have the Wave 5 button on, the Elliott Wave button, but no qualified 5-wave pattern. Our target price was 600. And look at that. Look where we went today. So the high of the day was 598.99. So 599. We were looking for this to test those highs from July. That was the idea, and it's done that. So we're crossing MPWR off. If you didn't close that out today, if you were following it and you didn't close it out, you might be being a little greedy. If it does get above 600, you can make a case for it could really take off and run. But it's a little vertical on the move here. I don't know that it has the energy to break above 600 and keep running. Maybe it does. But I think looking at the ADX is well above 40, going up towards 45. I mean, it still looks really strong. But remember that when the ADX gets above 40, it's telling you the strongest part of the move is over. It doesn't mean the entire move is over, but it means the strongest part is over. So could MPWR move above 600 and go higher? It could, but significantly so? I don't really think so, not based on what we're seeing out of the DMI and specifically the ADX. So I think you take that as a winner. You're happy with the move. and you move on. We looked at Visa back on the 21st of November. That's what we were looking at that point in time. And nice day today in Visa, 1.2%, over $3 move to the upside coming out of this little triangle here. So that looks great. And you would expect that this time of the year with the holiday spending season, you know, if one of these stocks like Visa is going to do anything, this would be the time of the year to do it, and it has. So that's a really nice move. So if we go back and look at the entry price, was at 252, and today 259.50. So over a 7-point move. You know, if you wanted to see if you got any further follow through, we're getting pretty close to what would be expected. This triangle was not that large, so the 2 breakout days are probably about the width of the triangle, so that move is probably factored in. But you could also say, well, you know, it's broken out. I want to see if it can continue to run, but I would watch this one really closely because this should be awfully close to taking your profits and moving on to something else. But we'll leave it for now and see if there's anything further. But I certainly wouldn't hold it against you if you said, no, I'm good now. You know, I'm going to take that 7.5-point move, take the gains and move on. I couldn't blame you at all if that was your viewpoint. Looking at Apple, last week, that was our case study consideration last week, and it's kind of just hanging around there. Is pretty much where it was last week. We were at what, 193.42, and we're at 190. So we were up $1.30 roughly from last week. So we'll keep that one alive, and then we'll make a note that Jeff gave us the CarMax, the KMX on a breakout either direction, and we'll see how that plays out. We won't know next week because the earnings are the 21st, so maybe after the holidays, because we'll take the holiday week off. Maybe after that, before we come back and see how KMX did on their earnings report. But with that, Zach, all that stuff still managed to finish on time. So we got a few minutes here. We can go ahead and take some questions.
Yeah, sounds great. Another phenomenal presentation. Let's start out. Let's go back to that S&P chart, and we got a question on showing the longer term Elliott Wave pattern on the S&P and see how that jives with the newer shorter term count.
Okay, yeah, that's pretty interesting. Good question. So there's the short count, which just labeled to the wave 3. So I'll turn that off and put the because it sometimes gets confusing. There's the Elliott Wave long count, which does show totally different count. So which one's going to win out? So the long count is showing the wave 5 is extended right to the 61.8% fib level, which you would think that's a major point of resistance. You've heard me say this numerous times. I think it's the strongest of all fib levels. Normally acts as a pretty significant spot of support and resistance. So just breaking above that 460 level, does that mean we've kind of run into a wall here and perhaps we're going to just trade sideways for a while? As long as the market stays above 460, you have to be constructively bullish on the S&P. It's going to be really interesting to see how does it handle that 61.8% level in a wave 5. Now note that the wave 4 corrected 55%. On that 55% correction, you would expect 100% extension on the wave 5. So if it would have only gone to 38.2, you'd be saying, yeah, that's 61.8. That's the forecasted move. That's probably done. It does look like the wave 5 wants to go higher, even on the long count, but maybe a little bit of resistance here out of that 61.8% fib level. So yeah, slight difference there on the 2 counts from the long count and the short count, the regular count. And you can see that 5 and the 3 are in the exact same spot. So that's why I did it differently, so that you could be able to distinguish between the two, so they weren't laying on top of each other. But really good question.
Absolutely. All right, and there's lots of chatter around Boeing. Let's check that one out.
Good old Boeing. They tend to talk about a V bottom. Remember the old adage, V bottoms never hold? That one did, or at least for now. And you can see that move. Do they have earnings coming up? Did something happen after hours? Not sure. Is all the chatter just because of the earnings report is not until the 23rd of January. So just I assume the chatter is because of this vertical move. But there you go. If you ever wondered what's a V bottom, that's a V bottom right there, because it makes a big V. I mean, that's exactly what it is. And so we've come up to this 240 level. That was the highs from July and August, and broken above it with follow through. So we broke above it, had a follow through day, kind of a little bit of a rest day today, letting that 10-day moving average catch up. But as long as Boeing stays above 240, I don't know how you couldn't be long Boeing, and looking towards that 270 level there, where that wave 5 target is. But a break below 240, you have to reevaluate things. So you keep that in the back of your mind. But as long as it's above 240, it looks constructively long to me. But gosh, what a absolute golden example of a V bottom chart right there.
Yeah, it's quite the climb right there. All right, very well. Thanks, Rob. Let's go over to Path.
Yeah, we had somebody joking on YouTube saying, "Why didn't you tell me about that move?" Well, I wish I would have known about that move. But this is, the whole AI story. And one of the things that I commented on last weekend's market update on our YouTube channel, the Elliott Wave Options YouTube channel, was the fact that money is just seeking out these AI plays that haven't participated, like an Nvidia, Microsoft, Google, the other ones that you're all familiar with, looking at something like UiPath, as people call it, making that big break there on the earnings report was because of the AI stuff. It's gone through a pretty decent consolidation here, a little bit of a symmetrical triangle, tried to break out today and couldn't hold it. So we actually closed right at the point of the triangle. So you can't call that a breakout. So you're just going to want to keep an eye on that. And then the nervous part is, that vertical move on the gap up. So you got a vertical move and a gap on the earnings report. So that makes you a little bit nervous. But, as long as it stays above 21 and you have a little bit of a longer term horizon, I think you have to stay long this. Now, it may take some time to digest that big move after earnings, maybe even breaks to the downside out of that triangle, comes down, fills the gap, tests 21. All that would still be constructively bullish, I would argue. But it could also break to the upside out of this triangle and just go and run right to that wave 5 target. But the key is 21. So if you have a position in it, I'd stay long. If you're looking to get long, you could take a guess on the triangle, or maybe the more prudent thing is to let it break from the triangle. But if you're holding a position, as long as it stays above 21, I would stay in there. But so far, fairly constructive consolidation following the earnings report, although it is a symmetrical triangle.
Very well. All right. Next up, let's go to Adobe. What's going on there?
Adobe's another one that had its big significant move. So you can see there, wave 5 earnings is tomorrow. Yeah, we want to look at this next week and see what happened on the earnings report. There have been times, and people have asked me about this, a very common question: do you hold trades through earnings, or why do you? And if I have a really well-formed pattern, zigzag, within a wave 3, or a good strong wave 5, some sort of a really strong pattern from an Elliott Wave standpoint that's backed up by the confirming indicators that we look at, the DMI, the CCI, CMF, etc. I will not shy away from holding a position through an earnings report. However, when you're looking at Adobe, the concern here is we're right there. We're right at that wave 5 target. Now, that doesn't mean it can't go higher. It could break higher and take off. It's only a 55% extension. But this would be a time where if I had been in Adobe for a while and had a gain, I might go ahead and take the profits in front of the earnings report, knowing that, we could have a great report and burst higher. But we're right there at that wave 5 target. And so from that standpoint, I might be apt to go ahead and take my profits here on Adobe and see what happens on the earnings and figure out a trading strategy from there.
Very well. We got a question from Emmanuel via Zoom here. Can you please review a firm stock and let me know your thoughts? Has risen over 100% in the less than 45 days.
Well, if you've done any online shopping, they're everywhere, right? I mean, so, I guess we'll have to wait and see if everybody makes all their payments. That's going to be the key. But as I talked about before, when Visa, this time of the year, you would expect to be a bullish time. And same thing here. People are shopping, people are online shopping, and firms everywhere with helping to finance out purchases, etc. And so it had a pretty nice vertical move, consolidated it. You can see pretty much touched the 10-day moving average on the low today. So let's take a look at the see, here's the problem. The ADX is above 50. So once it gets above 40, it's telling you the strongest part of the move is over. It's above 50. Now, that doesn't mean it can't go higher. The ADX can still go higher, but you can see the positive directional indicator has broken below the ADX. I guess my point is, can a firm go higher? Yes, but it will be a much weaker move than what has occurred already. So the DMI is telling you that was the strongest part of the move. And as I said before, I'm reiterating, an ADX above 40 doesn't mean the move is over. People always get that confused. That's why I say it so often. It means the strongest part of the move is over. It doesn't mean it can't go higher, but you'd have to be very cautious of that move because it won't have near the strength and could get corrected pretty quickly. So I feel like looking at that, perhaps, the biggest money has been made. I would have a hard time being too bullish on it at this point in time, just because that DMI is telling me that even if it goes higher, it'll be a fairly weak move. So I think I would kind of wait and see on that one.
All right, a couple of charts for you from Harvey via Zoom. First one, JPM.
Good old JP Morgan. We've had a little bit of movement. So let's see how JP Morgan has been doing, trying to catch a pretty good bid here. As you can see, breaking above those July highs, which is key. So nice move today. So we had a couple up days, but today is really the breakout day from those July highs. So now we want to look and see if we get follow through. Now look again at the ADX that's above 50 again. So it looks like some of these moves are getting rather mature, and makes you wonder how much further they can go. The positive directional indicator, unlike a firm, which was going down, is actually turning and going back to the upside. So if that positive directional indicator can get above the ADX, then it'll tell you there's probably a little bit more to run on JP Morgan, but no 5-wave pattern. Earnings coming up on January 12th. If we get follow through tomorrow, we likely go a little higher from here, but I would be concerned about how high that ADX is. And again, the strongest part of the move being back here, and any further move to the upside, which I'm not saying it can go higher, it can, but it would be a weaker move, and you would want to be, tightening your stops and, don't be as patient with corrections as you might otherwise, due to the fact that ADX is so high.
Alrighty, going to rapid fire some symbols at you with the time remaining. Let's go over to ABBV.
Good old AbbVie. We haven't looked at this one in a while, and holy cow! Back in the whole COVID days, this was along with a couple of the other ones was on the radar screen every week. It seemed like. Now this is a little better DMI here, so the ADX is moving up and hasn't gotten to 40 yet. Positive directional indicator, higher, negative, lower. All that looks good. So the issue here is that we are coming up to resistance right here at 155. It tried to break above it in April, couldn't hold it. Tested it in August, tested it in September, came down, caught itself around 140. Now it's making another run. And as suggested by the DMI, it looks like it may be successful here. Now it's a tiny bit overbought, so you don't want it to break above 155 tomorrow. So if you're long this stock, you're like, okay, calm down. Let's go sideways for a couple of days, gain some energy, gain some momentum, and then break above 155, and then it could take off and run. So if you're conservative, you want to see it break above 155 with follow through. If you are a bit more of a risk taker, you could say, oh, well, that DMI says it's going to break 155. I'm okay if it goes sideways for a few days first. So that would be the aggressive stance. But the more conservative one would be let it show you it can break 155 and then enter. And if it does, then you probably have a ways to run based on the way that DMI is setting up.
Very well. All right. I see we are at time. You got time for, let's say, maybe two more symbols?
Two more. Sounds good.
All right. So let's check out Skin.
Skin. Holy cow. Haven't heard that symbol in so long. But big breakdown here from a really important level. It needed to hold 5. We've gone through these numbers that have to do with institutional ownership, 10 being important for institutions that have growth as their investment objective. If you go down to single digits, you have to be registered as aggressive growth. And when you break below 5, you're in danger of breaking down below 1 and going to the pink sheets. And based on this earnings report, which clearly wasn't too good, they lost 56 cents. I don't know what the expectation was, but the market didn't like it. It has bounced back a little bit, but only to come up and fill this gap right here. So if you're doing some, like really short-term trading here, perhaps you get that gap filled. So the low there was 345. So the high here, 316. Maybe you get that gap filled. Based on what I'm seeing there, I wouldn't have much hope other than that. And I mean, I know it looks impressive that it's come back from below 2 back to 3, but it just was way oversold. And looks to me like it's just trying to fill that gap, maybe test that 50-day moving average. But yeah, I'd be super cautious on that one. All right, last one.
Last one. And I just want to say another great presentation. Very excited for tomorrow's presentation as well. So everyone be sure to register. Don't miss out on that opportunity. I'll send the link in one more time before Rob signs off. Let's go ahead and look at UNG to wrap things up. And thank you all for attending this live. Oh, there was one last thing I wanted to say. We appreciate your positive feedback that you are so graciously providing us with every week. If you don't mind smashing that like button for Rob, if you enjoyed this presentation, it does go a long way for us, and we greatly appreciate it. So back over to you, Rob.
Thanks, Zach. Appreciate you saying that, and thanks for everybody. We do appreciate it when you smash that like button. We this is free. We're just spending time to chat with y'all and do our best to help you out in any way that we can from a educational standpoint. And natural gas, I just keep shaking my head. We need a big snowstorm. I can tell you, it's cold up here in the mountains. It was interesting watching the thermometer in the car go down, the truck go down as drove up. You keep driving. Started to get towards dawn, which you would think would start to warm up, and they just kept getting colder. So it's cold up here, but it's not cold enough, obviously. So we need like a blizzard of some kind to put some sort of a bid under these. But as I said, oil's not doing it either. So what's up with the energy stocks? If everything is going to be okay economically, they should be responding, and they haven't been. And so that's the fly in the ointment right now on why we don't feel even better about going long at this point. We did break 460. That was our key. So as long as we can stay above there, I think you have to be long, but cautiously until we get some of these indicators in line, energy being one of them. And so right now that break below 5 is pretty scary at this point in time. So the wave 5 is down there around 3.5, and I think that could happen. I'm not a big fan of the DMI, as y'all probably know. If you wonder, well, why is that? Why do you like it so much on upward moves, not so much on downward moves? And that's because the downward moves occur so fast, and the DMI is a bit more of a lagging indicator. That's why we look at the CCI combined with it, because it's more responsive on day-to-day actions in the market. And the CCI is just languishing down here around these extreme point lows. So that's kind of telling you that, gosh, we should find a bottom at some point, but it hasn't tried to make any sort of an upward move either as we've drifted lower. So we could continue to drift down and keep that CCI down there. What that's telling you is whenever the bottom comes in, there will be a tradable bounce because of how low that CCI is, but it doesn't tell you when that's going to happen. So you just got to kind of keep an eye on it. It's on my screen every single day looking at it. I was really surprised on the break below 6 and even more surprised on the break below 5, and it didn't even really hang around there but 3 days. At least 6 has been support for the year, but breaking below that and heading lower, it wouldn't shock me to see it move down into that wave 5 tap box. But keep an eye on it, because based on the CCI, there will be a tradable bounce at some point. So keep watching it and see what that is, and be on top of it. Thanks everybody, as always. Appreciate your time. Time's the most valuable asset we all have. Very much appreciate you donating your valuable time to us, and we hope we make it an informative and educational use of your time. So hopefully everybody register for tomorrow night. It's going to be great stuff. Got nothing to lose. It's free. And we look forward to seeing you then. Otherwise,